Hey there, everyone. My name is Ryan Schul. Welcome to my channel. So in the narrative today, I want to take a look at creating a dynamic portfolio of loans and then pricing out these loans and focus on things like probability of default, that's PD, and loss given default, that's LGD. Okay, so we're going to take a look at these and then check the accuracy of the models and how precisely they're making calculations. And then we're going to look at a couple of visual reports at the end so we can see just in the form of a chart or a couple of different charts what this stuff looks like. So again, this is dynamic loan pricing. We have to fetch the data, go ahead and collect the data, train the models, and then interpret the outputs of the models. We're looking at different things like FICO, loan to value, debt to income of these different borrowers to try to understand how risky it is to issue a loan to different types of borrowers, right? So we're going to look at PD models, LGD models, things like that, and we are going to rely on a couple different modeling tools. We're going to look at gradient boosting classifier and gradient boosting regressor. So I don't have access to this data. This is all specific to a bank or some type of financial institution, maybe a credit card issuer or something like this, right? So obviously I don't work at the bank, I'm not going to have access to this data, so I have to create it synthetically. So in the past, I did work for a number of banks, and I think this data set is pretty accurate. I think it's pretty realistic. I think the analysis is pretty realistic, but again, like if you were doing this for some type of financial enterprise, you would plug in your own data. You wouldn't create data, right? It doesn't really make sense. But in my case, I can't do that. I don't have your data. You don't have my data. Well, you have the synthetic data, but that's it, right? I can't go out and get your actual data. So just keep that in mind. It should be pretty obvious anyways. So I'm going to create a UDF here. This is a user-defined function to help me with FICO scores, loan to value, debt to income. Income, the term of the borrowing period. This is going to be 60 months. Loan amount, is it secured or unsecured? So a lot of this should be pretty common sense if you do work at a financial institution doing risk management or risk assessment or something, right? And if not, then you're in for a treat today. You're going to learn this stuff. It's pretty interesting, I think. So this final calculation here would be expected loss. So if we have a probability of default and loss given default, what is the overall expected loss? And then the unexpected loss, right? So we can try to make predictions into the future, and this should be pretty accurate. But there could be scenarios that we can't anticipate. We would expect the borrower to pay off, but for whatever reason, and it could be a variety of different things, the borrower actually does not pay off, even if that looks like a good credit profile, and the amount of the loan is pretty low, and overall the risk seems pretty minimum. There can be unexpected losses, right? So we know the expected loss pretty accurately. There could be some unexpected losses as well. So let me go ahead and run this just to refresh the cell, right, and get everything loaded up here. So again, we're looking at pretty big data set, 60 periods, about 120,000 different loans. So pretty broad in its scope here. We built a 60-month sinusoidal series looking at interest rate levels, credit index, unemployment, so big macro factors, right? We're looking at some economic features here, and then we want to understand the FICO score, the loan to value, the debt to income, the volatility of the person's income, loan amount. Is it secured? Is this unsecured? Right? If it's unsecured, we're not going to issue quite as much credit to this person like a credit card, right? But if it's secured by a house or by a car, then you actually have an asset that actually backs up the loan, right? And you can go ahead and reclaim the asset if you are the issuer, because you basically own that. You own the asset. You just lent money to this person that is paying you back for the privilege of getting the asset today. They're going to pay for the asset over a period of time, right? So whether it's unsecured or secured makes a pretty big difference too. So we have the data. It looks decent to me. Month FICO, loan to value, debt to income, and a few other features over here, loss given default, and then spreads in terms of basis points. So that looks good to me. I'm going to go ahead and set up some feature columns, Control Enter. Okay, and again, we're looking at the probability of default and then the loss given default. And we want to look at the area under the curve. This is the AUC and the mean absolute error. So these are slightly different ways of doing the prediction, and pay close attention to this because the probability of default really is a classification problem, right? So it's either the borrower is going to default or not default. It's not like, well, quasi default or maybe will default on this portion. It doesn't really work like that. It's either one or the other, right? So 0 would be pretty safe, no default. 1 would be a default, but it's pretty much really just a binary outcome. Loss given default is much more continuous, right? So it's not discrete like a classification model is. This is time continuous or numerically continuous. So the loss can be any one of a whole bunch of different numbers, right? The probability of default is either yes or no. These are the only two outcomes, right? So just to draw your attention to that. And then there's a couple different mathematical operations we do down here. Again, expected loss. If we have a probability of default and the loss given default, how much is that default? The expected loss is going to be numerical. Again, that's going to be continuous, not discrete. And then the unexpected loss, we have to try to take like a realistic, I would say, check or realistic kind of estimate of what this unexpected loss is going to be, but we really don't know, right? Because we don't know what the probability of default is with 100% accuracy. So we're doing this model and we're going to have very good insight into this, but we can't absolutely predict with 100% accuracy who will default and who won't. If we could do that, we would just assign loans to people that we know would not default, right? We're trying to make predictions and estimates in the future about what's going to happen rather than just random guesses, right? So the model is going to help us make intelligent, informed decisions. But again, it's not going to be 100% accurate. And there's scenarios that come up that that you just can't anticipate, right? So it's kind of like a pretty, I was integrated or pretty, what's the word I was looking for? Holistic or even, what is it? Maybe it doesn't even matter. Integrated problem. Trying to think of the term. Anyways, it's pretty tightly bound. So these things work in a pretty complex fashion, right? But we're trying to peel back the layers of the onion here and understand like basically what's going on. And again, try to make informed, intelligent decisions about who to issue loans to, okay? So we have this user-defined function that helps us with that. We have price components down here, expected loss in basis points, capital basis points, liquidity, Opex. This is operational expenses in terms of continuing to do business for this enterprise, right? We have Opex or CapEx. CapEx is more of a long-term investment that pays off over a period of time, more like a hard tangible asset. And Opex is more like, okay, how much does it cost for electricity? How much does it cost for rent, right? How do we, what are these costs associated with the operations of this business? Profit in basis points and then total basis points over here. So let me hit Control Enter to run it. Okay, and we should have our results. And again, PD calculation is really more of a classification type of problem because you have that binary outcome, either there's a default or no default. And the LGD is much more of a regression kind of problem because the default could be, or PD could be either default or not default. That's basically the only outcome. LGD can be any one of a whole bunch of different losses, right? Anywhere from, I'm just guessing like here, from a few $1,000s up to hundreds of thousands, maybe millions of dollars, and anything in between, right? So the loss given default can be a whole bunch of different possible outcomes. PD can only be 2, right? So we have to apply the right model to solve the right problem, right? So this is still running here. I can see the hourglass in the upper left-hand side of the screen. Okay, so give that just a moment to run. Okay, we're back in business now. I had to wait for that process to finish. It takes probably 12 minutes, give or take. So, okay, we're in a good spot. We have the probability of default and the area under the curve. This is about 0.73% accurate. So higher is better. Lower is not quite so good. If you have like 0.5 here, basically half the time you're going to be right, half the time you're going to be wrong. That's a pretty low number. We want to see something higher 0.7 and greater is okay. 0.8 is better. 0.9 is actually better. And then we have the loss given default, mean average area 0.04. So that is pretty small. As this number increases right here, this number will decrease down here. So these two function together very closely, but the 0.73 is not fantastic. This is not phenomenal. Now there's other models that we can test. This video is not about testing whatever 10 or 15 different models, and it's not about getting the absolute highest AUC or the MAE. There are ways to do that. I have other videos that describe exactly how to do that. If I put that in this one and rerun the process iterations over and over, it would just drag on and on and on, and the video would go on for a couple of hours. So I'm not going to repeat that because I have other videos that address these specific things, but there are hyperparameters you can try or just test different models and see what the output is. Okay, so this is just a general overview of how to create a dynamic loan pricing model. So let's move on here. We have borrowers, and we have a baseline and a stress scenario. You'll see that down here. So stress is, where is that in the loop? Stress is stress and baseline is baseline. Basically, we're creating a couple loops here. This is a UDF user-defined function, and we're going to loop through two items here. So the name and then the scenario in baseline and stress test customers. So we can do multiple loops simultaneously. We could split this out. I don't think it makes a whole lot of sense to do that. This is just more compact and more, what is it called? Pythonic. I think Pythonic is kind of the term where everything is made basically as efficient as possible, and not just do a little bit over here, do a little bit over here, do some other things over here, and then try to tie everything back together. Pythonic is more like writing very efficient, highly scalable, highly reliable code, right? So this is kind of like the Pythonic sort of view that you would have here. So we're comparing borrowers using Plotly. So I'm going to create a couple of Plotly charts at the end. I always say a picture is worth 1,000 words, right? If you can take a look at the plots and charts and understand graphically what's going on, that is going to be, I think, a lot more illuminating and a lot more, what's the word? A lot more useful, I guess, rather than just have the models create a bunch of output that looks like this down here. Okay, this is the output when they run the code. Now that is critical to create the chart, and it is very helpful too, but if you put this in front of most people, they're not necessarily going to know what this is, right? So that's why we create the charts at the end to tie everything together. So again, we're looking at FICO scores, loan to value, debt to income. Unsecured, this is a binary outcome. Either you have some type of secured loan, which would be an auto loan, a mortgage, home equity loan, where there's collateral behind the loan, right? It's not just a promise to repay the loan. If for some reason the auto loan is not repaid, you can go ahead, the bank can go ahead and reclaim that asset, right? You can have a, what's it called? The guy that repo, right? You can repossess that asset, whether it's a car or a home. You also have unsecured loans like credit card loans, student loans, personal loans. There's no collateral behind it other than goodwill promise to pay on that loan. It's not like if you're a student and you default on the loan, you can somehow give back your education. That's not possible to do, right? So maybe with a credit card, the repo guy can repossess some of the things you bought, like a big screen TV or something like that. So there might be ways, it's still not real collateral, but there might be ways to lessen the blow of a default on a credit card loan. With a student loan, offhand, I can't think of how the bank can or the lender can somehow collateralize those because there's no collateral there. Okay, so anyway, so when we run the code, we get the FICO, loan to value, debt to income, is it secured or unsecured, and then the spread in basis points. So let's move on to the next thing here. We have the Plotly charts. I think this is the last part. Yeah, let me run this. This goes pretty quick. So Control Enter. Okay, I think it already ran. The baseline is not defined. Wait a second. Why would the baseline not be defined? Because I just did it over here. Baseline is right here. Let's try this again. Okay. Okay, so I think it's running. I don't know what that was, some little hiccup or something. Or maybe I didn't refresh one of these cells in Notebook, but I thought I hit every one, so maybe I missed something. Okay, so here we have the quoted spread by borrower and scenario. So we have a couple different scenarios here, or a couple different borrowers, number 1, 2, and 3, and then we have the baseline and then the stress test. So the stress would be more like, if there's a shock to the economy, unemployment spikes up. Certainly during COVID, we saw a lot of weirdness, a lot of people defaulting on loans. During the 2008 financial crisis, there was a huge spike. So that would be a typical stress scenario. And you try to model these out to understand, what's the most likely baseline scenario? What's the most likely in terms of basis points spreads? How much is this really going to move in a normal economic cycle, right? And then the stress test would be like, okay, if we add some stress points on here, how much is the basis point spread going to increase, right? So over here for borrower number 3 is really not too much of a change. For borrower number 2, the stress scenario is increasing basis points a little bit. And for number 1, it's definitely an increase, not a substantial increase, but somewhat of an increase here. So here we see a bar chart comparing quoted spreads by borrower under baseline versus stress. B1 is probably pretty typical here. B3, like usually those don't work out exactly the same in terms of baseline and stress, but that could happen. That could definitely happen. And again, these are simulations, right? So we're trying to recreate a scenario, or basically create a scenario that hasn't really happened yet, but we know essentially from historical events in the economy, either endogenous or exogenous. Endogenous would be internal, exogenous would be coming from the outside. What kind of impact that could have. And again, it could be a contagion like COVID, or some type of financial shock to the system like 2008 or something else. I mean, maybe, who knows what, maybe a meteorite hits the earth, causes like massive chaos, and all of a sudden a lot of people start to not pay off on the loans that they've borrowed. But that would be a very highly unlikely event. And if there's a major impact hitting the earth, we probably wouldn't have to worry about paying back any loans at all, because that could be the end of the earth. But who knows? Like, you try to pick some different, somewhat realistic scenarios and model those. So we also have a heat map down here. So the heat map basically shows me the baseline and the stress scenarios, and you can see in the stress scenario, these numbers are slightly higher over here. So I have 2000 right here, right, and 1626 in a more likely, more realistic type of event. 596, so it'll be a little bit higher over here, and the baseline be 462. So this heat map basically just shows you a distribution of different possible FICO buckets based on the loan to value, how baseline basis point spreads can increase or decrease. And here we have a typical waterfall chart where we have the expected loss, capital, liquidity, Opex, and the profit, and then the total. So these are all aggregated together in the final chart over here, okay? What else do I have in my notes? So I also have a rate card heat map. Yep, I talked about that. And sweeps across FICO buckets and LTV buckets. So this is pretty cool, because you can see everything everywhere all at once in these heat maps. I really like this a lot. So you have on the y-axis the FICO bucket, and based on all those different FICO buckets, we look at the loan to value bucket on the x-axis and see comprehensively and holistically how everything's tied together. So what did we achieve here? We accomplished basically the creation of a mini credit pricing pipeline built end to end using, again, synthetic data. I don't have actual data. You would load your real historical data into this model and run it. We're looking at loans, macro conditions, training the model for PD, LGD, and then using those models and pricing in the pricing engine that quotes a spread in basis points and shows visual breakdown of scenarios and charts. So where can we go from here? Plug it in real features and outcomes, right? So again, I said this a couple times, I don't have your data, you have your data. You could upload the data and feed that into the model pretty easily, right out of the box. That should work for you just fine. And then that will give you your specific PDs and LGDs. What else? Lenders sometimes constraint models So price increases with loan to value and debt to income. So that makes sense too. Like I'm not really handling that part here, but as the loan to value increases and the debt to income increases, really that potentially could have a big impact on FICO, right? So if you're loaning a lot more money, the loan to value increases, and this person has a lot more debt, this is going to be a higher risk, right? So it's something you just want to be aware of, or you might cap it or just not issue loans to people that have these types of profiles, right? So capital liquidity is key. You want to be very liquid. We saw a lot of liquidity issues during the 2008 financial crisis. Scenario controls. So again, this is a pretty realistic model. There are ways to improve it. You can add in different cutoffs, different parameters, put some guardrails here. So if you have a high risk profile, a potential customer, they just get kicked out right away immediately. That is gone. You don't even do business with that type of person. And layer in things like limits, overrides, require more equity up front or more higher down payment for a house, something like that, or for a car, or more equity, higher down payment. Make sure that the collateral behind the loan is pretty stable and pretty secure. So if the person defaults, you can go grab that asset, right, and sell that. It would probably be at a discount because the bank is not in the business of collecting cars and selling cars. Banks do banking things. They don't sell cars. And it's not in the business of selling houses, right? Real estate agents do that. So they don't really want to get into these fringe businesses. They really want to just lend the money, collect interest payments, and, at the maturity of the loan, it's off. Thanks for doing business with us, that kind of thing, right? And then again, with student loans and credit cards, they're unsecured. So really it requires probably a little bit more diligence in these areas and some common sense too, right? So if a person is going to school and majoring in or picks a major that probably will not generate a whole lot of income after graduation, do you really want to loan this person hundreds of thousands of dollars? Like some of this is just common sense too, right? I wouldn't be doing that. So again, you can put in guardrails and handle these types of scenarios or these types of requests from a potential borrower to say, if this looks like a high risk loan, just don't even get involved, kick it out and move on to the next guy and continue the process with a low risk potential client. Okay, that's it, guys. That's all I have for this topic. Hopefully that was useful and insightful. I will post all this code. I will save it right now. File, save as HTML. So you have all the code. You can copy and paste this into your own Jupyter notebook and run it as is. Okay, so that's it. I'm wrapping up here, and I'll see you guys in the next one. Goodbye for now.